The real estate market is shifting again, and if you've been feeling it, you're not alone. Agents everywhere are trying to figure out what's really going on with interest rates, the economy, and housing demand. The headlines say the Fed is cutting rates, and social media is buzzing with excitement. Everyone's asking, does this mean the housing market is finally about to open up? Are mortgage rates about to drop? Hey friends, it's Gary Carpenter with Master Real Estate Academy, and the Fed just announced not one, but a couple of rate cuts, and possibly one more before the end of the year. And if you're like most agents, you're probably thinking, finally, mortgage rates are coming down. But here's the thing, they're not. In fact, what the Fed just did could actually keep mortgage rates higher for longer, even though they just lowered short-term rates. I know that sounds backwards, but stick with me, because understanding this change could help you protect your business, better advise your clients, and position yourself to thrive in the market we're heading into. Let's start with what really happened. The Fed didn't just cut rates. They also made a quiet but incredibly important move that most people completely missed. They announced they're ending something called quantitative tightening, or QT. That simply means they're done shrinking their balance sheet. Over the past 2 years, the Fed has been selling assets and letting others expire, pulling more than $2.5 trillion out of the system. That's one of the reasons liquidity has been so tight and mortgage rates have stayed high. Now they're saying we're done tightening. And at first, that sounds like good news, right? But here's where it gets tricky. They're not just stopping QT, they're redirecting where their money goes next. Here's what that means. The Fed holds two main types of assets, U.S. Treasuries and mortgage-backed securities. Those are bundles of home loans that help determine mortgage rates. Normally, when homeowners refinance or pay off their mortgages, that money goes back to the Fed, and the Fed reinvests it in buying more mortgage bonds. That helps keep demand strong and interest rates lower. But starting December 1st, that changes. Instead of reinvesting in mortgage bonds, the Fed is now shifting to short-term government debt, treasury bills. In other words, they're choosing to support the government's borrowing and not the housing market. So why does this matter to you and your clients? Because mortgage rates are directly tied to supply and demand for mortgage-backed securities. When the Fed stops buying them, demand drops, prices fall, and mortgage rates rise. That's why we just saw the Fed cut short-term interest rates, but mortgage rates actually went up, not down. The Fed is giving the government cheaper borrowing power, but it's coming at the expense of home buyers. It's a quiet move that helps Washington balance its books but keeps mortgage costs elevated for everyday Americans. Here's the bigger picture. The U.S. government is spending at record levels, and it needs cheaper access to capital to manage its debt. But buying short-term treasuries, the Fed is lowering government borrowing costs, but at the same time, it's pulling money away from the housing market. The result is that mortgage rates will likely stay sticky and higher than most people expect, even though the news is filled with all this talk of rate cuts. Now, before you panic, let me tell you something encouraging. A slower market doesn't mean a bad market. In fact, it can be one of the best environments for experienced, skilled professionals to grow market share. Let me explain why. When the market gets hot, and homes sell themselves, commission rates go down. We saw that in 2005 and again during the pandemic boom. But when the market cools off and sellers realize they need real expertise to get homes sold, commission rates rise. After 2008, that's exactly what happened. People started turning back to the pros. And right now, that same trend is happening again. Another silver lining is less competition. When the market's easy, everybody wants to be in real estate. During the pandemic, it felt like everyone and their cousin got a license. But when things get challenging, many of those part-time or discount agents drop out. We're already seeing it. Big companies like Zillow have pulled back from their iBuyer models, and flat fee or disruptor brokerages are quietly fading away. That means fewer competitors and more opportunity for true professionals who are committed to this business long term. And finally, tougher markets always create more listing opportunities. We're already seeing more expired listings, more for sale by owners, and more agents struggling to get homes sold. The agents who rely on the old listed and wait strategy are getting exposed. Meanwhile, those who know how to price properly, market strategically, and communicate value are thriving. Some of the agents I coach are having their best years ever, not because the market is booming, but because they're stepping into gaps other agents have left behind. So if you're serious about not just surviving, but thriving in this new market, this is the time to double down on your skills. Focus on becoming the listing expert in your area. Learn to price, present, and negotiate like a professional. That's exactly why I created the Realtor Roadmap training and coaching program. It's built from everything I've learned over the past 28 years about creating a predictable, profitable real estate business that can weather any market. You can click the link below to find out more. The bottom line is this: don't get distracted by the headlines. Don't react to the noise. The agents who win in this market are the ones who understand what's really happening and lead with confidence when everyone else is confused. This next phase in real estate is going to reward skill, consistency, and professionalism like never before. So stay sharp, stay focused, and keep running your race. If you found this video helpful, make sure you hit subscribe, share it with another agent who needs to hear it, and I'll see you in the next video.